A very warm welcome to all the viewers of Ticker Market. So in today's market interaction, we have a very high profile guest. He is CEO of DHFL Pramerica, Mr. Rajesh Iyer, and the group overseas funds over 24,000 crores. Mr. Iyer, welcome to Ticker Markets.
Thank you so much.
So we are talking about Indian markets and road ahead. To begin with, global factors, what do you think? There are a lot of events that are lined up. You have global interest rates as well. You're talking about ECB meet, which is also lined up. Bank of Japan is also meeting. What do you make out of all these global events to begin with?
I think the focus for us in India is the US Fed and what it plans to do. As we've seen in the recent times, the interest rate, the Fed has raised, and done its hike. There were a lot of questions on that, whether it will do or not do, because let us remember one important thing here. The inflation in the US is still very anemic.
Right.
The whole assumption is that we are in full employment as far as the workers and the wages go. So typically the assumption which I think the Fed and the others are making is that as we are in full employment and the fact that there is increased demand for workers and the wages will be under upward pressure, which is why they are kind of contemplating that they will do a reversion to the earlier quantitative easing policy, and they will take the interest rates up. So I think if the interest rates go up, that is what I think we should be really very concerned. The rest of the world seems to be just chugging along. Europe anyway was doing much better than the US earlier. US has now picked up phenomenally as far as GDP growth is concerned. So what is to be very important going forward is the US Fed, and what it does to the interest rates is going to be very critical for India.
So we're talking about markets and road ahead. Its impact on Indian markets, and talking about macro and micros. To begin with, domestic market is all about fundamentals, and as we have already seen that macros are not doing that really well. So what's your take on Indian markets going ahead?
One is, as I said, the Fed interest rate, the way it behaves, because that will put pressure on the Indian RBI to align, because already there is a 500 basis points difference between the 3% of Fed versus 8% where we are. So 5% is quite a bit, and if they move another 50 basis points, I think we will have to move as well, because the exchange, as you have, keeping the inflation in mind, where the interest rate in the US is, and the second big factor for us on the macro is the crude. And with every $10 of crude price going up, you will see $12 billion worth of CAD, which is your current account deficit, also under pressure. So just remember, 10 billion, 12 billion. And we have already seen the CAD going up from 70 to, it is going to be around 100 billion by the end of this year.
These all factors are disturbing the market.
So you will see pressure on the currency, and with that, the interest rates, obviously the cost of funding will go up, and you will have the cost of input.
And that will drill down to the micro, that means earnings.
Yeah, so these are the macro-led factors which are at least temporarily, weighing more on the fundamentals.
True. And if you're talking about micro factors, I mean, I'm talking about, as you have rightly said, that larger concerns from the global market and CAD concerns and the rising inflation and stuff like that. What are the three important micro factors that's impressing you?
I think the most important point is that temporarily, as we look at it, these macro factors are kind of having a very ill-full effect as far as earnings, upsides are concerned, and it has been constantly affecting the whole hypothesis that we've had in terms of the earnings. So also this is an election year, we need to keep in mind. So from a government expenditure point of view, you will see a lot of pressure in terms of fisc. Perfect. And as the fisc also is under pressure, the interest rates again, it will come back. So it's not only inflation led by crude or what the US is doing, but also because it's an election year, you will have a little bit pressure from that side as well.
Mid cap and small cap stocks, we have seen these stocks correcting, and broader part of the economy, talking about retail investors have invested a lot in these pockets. So we'll discuss in this segment more about small cap and mid cap. Sure. What is the reason? Because to give a background on the small and mid cap stock, we have seen larger part of the accumulation happening between 2013 and 2016, and we have also also seen the commodity prices have come down, interest rates have come down. So during this time, these are the stocks that have benefited. Plus, mutual funds has also accumulated. So what is the reason, do you think so, that has been top concerns for these stocks to correct, and is it the right opportunity to pick these stocks?
Yeah, so the main concern is the valuation, of course.
Sure.
I mean, that's well talked about, so I don't need to stress upon that. So the whole hypothesis has been that all the incremental flows which have happened, and you've seen some phenomenal historic flows as far as the domestic retail money goes. So to that extent, the demand for stocks has always gone up. On the other side, the expectations that the earnings will come about is something which is not happening. So the valuation still looks pretty, stiff. But having said that, the green shoots are there. The green shoot is one, which is one big thing that we need to remember. This is going to be a little long term, but we need to remember that there is a lot of activity on the agri side of the economy.
Right.
With the reforms that the present government has ushered in through the insurance, it is going to help the farmers to de-risk from the main the rainfall risk that
consumer focused stocks will do well.
Yeah, there will be more money in the hands of the farmers. That's what I'm trying to say. So with the insurance, with the higher quality crops, with the higher realizations, with the softwares that the government is introducing through apps through which the farmers can actually trade, there is more money which is there. So obviously when you're looking at the earnings also, there is improvement. If you look at the upgrades versus downgrades for the last 2 or 3 quarters,
so it's going up.
We've seen that improvement primarily because of the fact that the demand, as much as the supply in terms of money is coming from the government, through all the private capex is just not happened. The public is happening.
So in a nutshell, you're pointing on the government-led initiatives are taking the correct steps that government has taken for this agri is actually positive.
Is going to boost, and that has been doing that. So the earnings, if you look at it, generally the demand, I mean the automobile and all these other sectors which are more the consumption plays, has all benefited because of more money in the hands of the farmer.
So Raj, do you think so relative to the large cap, small cap and mid cap are still overvalued, or you have a different idea about it? And we are talking about purely about the retail investors perspective. Should they invest in small and mid cap? What's your take on that?
Actually, as of now, if you see, the mid cap and small cap have corrected anywhere between 20 to 40%. The large cap is still kind of held on, and in fact, I think what we are seeing is that the earnings, all the improvement that we are seeing a lot on the large cap, maybe lesser comparative to that in the small and mid cap. But having said that, we still believe that mid and small cap there is enough room for it to fall. And large cap is something that we need to watch as well for the valuations in terms of the difference, because the differential in valuation typically is in the region of 15 to 20% between the large and the mid cap, which had completely converged. Both of them were the same. Now that has come down, but it's not enough. So to that extent, if the large cap universe keeps going up and the mid cap universe keep falling, then there is an opportunity there for sure. But as of now, we still believe that there is room for fall in the mid and small cap,
so
and the large cap still is much
small cap to fall further.
Yeah,
we are talking about investments in Indian market. So is it safe to say that maybe 10 years down the line, I will be happy on my decision to invest in mid and small cap stocks, or should I go the SIP route? What's your take on that?
I think SIP continues still to be the best way of investing into the Indian markets, because that kind of gives you an opportunity to keep taking the benefit of the volatility, and we've seen 3 years of a bull run. So obviously we are getting into a market which is going to be a little more challenging than what we've seen over the last 3 years. So going forward, of course, if one were to look at investing over the next 1 to 1.5 years, I think SIP will really benefit because you'll be able to take advantage of the volatility.
That's it. What do you think so at the time when equity market is believing micros are improving, as you already said that there is a signs of micros are improving, that means earnings is improving, and you have also pointed out the larger concerns for the Indian economy from the crude prices. I'm talking about inflation and CAD and stuff like that. So what according to me, earnings picture from the last 4 years, please correct me if I'm wrong, has not changed a lot. We have built this expectation hoping that it will revive, but it's not reviving. If you have a different idea about it.
Going forward, we might see the level of 70 pretty soon, and maybe for the next 6 to 12 months you will see the currency under pressure because of all the macro factors that we discussed, relating to crude, relating to the US, etc., etc.
Right.
So I think exports is a good opportunity one should look at, and the earnings there we believe will be much better. Also, as I mentioned, the earnings, if you look at the way that it is really behaved, you've not seen substantial progress as far as the bottom line goes, though though on the cost side, due to the commodity prices coming down, the interest rates coming down, it has benefited. But on the revenue side, if you were to look at it, except a few businesses, many businesses haven't seen the demand pick up as much as it should be.
So that's what we are pointing out on the earnings front. So I would like to quote a recent research pickup from Edelweiss that said that Q4 FY18 was another disappointing quarter with profits for our coverage universe that is contracted 19% year on year versus our forecast of 13% year on year.
Right.
So what's your take on that?
Yeah, absolutely. So I think there are these two broad sectors.
Because we are hoping that earnings are improving, and then from the last 2-3 quarters we are trying to believe that earnings are improving, but
I think ex financials and ex commodities itself is also facing issues.
This is ex corporate banks and commodities.
Correct. So
that a big disappointment.
Absolutely. So that is also facing issues, and I think that is primarily due to the fact that you've come in from an era where the overall demand was slowly improving, and we were seeing a kind of a U curve,
Right.
But somewhere in the middle with demand happening, and of course, the GST also got introduced. So I think businesses also started taking some more time to align themselves. So towards that, you have again seen a little bit of dent, post, demand and GST. That phase I think is gotten over.
Right.
Now probably FY19 will be one full year where you didn't have any of these disruptions, and going forward when you get into FY20 is when we believe that all these benefits that we've any which ways had in the past with the agri related demand push which we will see.
Sure.
Hopefully we will see a little better
so we will discuss about
revenue profile.
So we will talk about the demonetization and the GST thing which you have highlighted. We talked to a lot of market participants, and as per the recent outlook report which we have published, though the revenues for the NSE listed companies ex financials have shown some signs of recovery in FY18, the EBITDA growth has been worst in a decade.
So as far as EBITDA growth is concerned, the universe of stocks which generally, and this I am talking about the investable universe,
all right,
leaving the indices out, because in the indices you would definitely have interludes of commodity or financials as we spoke, etc., etc. But otherwise we haven't seen this phenomenon for a fact.
Okay.
FY20 will be the test, and the expectations are 20% earnings growth for FY20 as far as Nifty is concerned.
Nifty stocks are concerned. All right. So we are talking about earnings growth in Indian domestic-led companies. So the capex has been a challenge for Indian companies. If you're talking about private companies versus the government company, we have seen a rise in government spending. We haven't seen a lot of pickup on the private companies front. So what's your expectations if this continues, the outlook for the private sector versus the government?
Yeah, absolutely. So I think all the earnings growth that we've spoken about is all thanks to the government. As you rightly said, 75% of the overall, if you see the spend, is all coming from the government, and I think that trend will continue over the next few quarters or maybe even a year from now. But having said that, the private capex, typically if you look at it, the capacity utilization levels currently are at about 70%. Unless you see that level going up to at least 80% or so, generally the private entrepreneurs will not take the call for going ahead with capex. So I believe that this is going to continue for the next 1 year. We're not going to see any substantial progress as far as the private capex is concerned.
So your expectations, FII flow versus DII and the continuation part of it?
FII flows will remain a little challenged thanks to all the global macro factors that we spoke about.
And you will continue to buy?
The domestic institutions has been continually supporting the markets, and we assume that will happen subject to a big shake-up which can happen if the election results are not in line with
expectations. Election year, larger concerns, please wait and watch.
Yes.
That's the message.
Yes.
So what will be the impact of increasing government spend on markets? I'm talking about the overall government spends.
Again, overall government spend this year will only lead towards not incremental capex, but towards other things which are related, to the election year, which is what we have today. So
sure, as you mentioned that you see rupee at 70 odd levels. So rupee is seen depreciating to 70 in near term, according to you.
Medium term.
And 80 by the year end.
I believe 80 is something that it's clearly evident at this point of time. 70, yes, in the medium term it looks plausible due to the factors that we spoke about. But it's clearly going to be a year where INR will be under pressure.
So crude outlook and rate trajectory. What's your take on that?
Yeah, crude, thanks to
what level?
It again, it all depends on the demand supply. But as of now, as we see, it's going to be under upward pressure for till the time
it will be elevated.
Yeah, because you have talks about Saudi Aramco listing and activity around that. So you will see that the crude levels will remain elevated. Rate hike, one has to see how the US Fed goes.
So it all depends upon the global market.
Yeah, but having said that, we believe that RBI is behind the curve, and a rate hike is expected in the medium term.
One last question. What's the outlook on Nifty for the year FY19?
Bottom line, how much performance is what you're asking, right?
So if you wanted to put a number to that.
Okay, so the earnings growth is about 20%.
Number on Nifty target.
Yeah, so we believe that with this being an election year, probably we will end up, even if the earnings achieves 80% of that, we might not be even half of that. So even if Nifty achieves 15%, if the political risk doesn't pan out and it's just a normal year, then we would kind of somewhere be between 10 to 15%.
That's it. That sums up today's conversation. So we had a conversation with Mr. Iyer. DHFL believes that there are larger concerns in the economy, but definitely in an election year, there are more ups and downs in markets, and markets are going to stay volatile. So please stay invested in SIP. Thank you so much for talking to Ticker Markets, sir.
Thank you so much. Thank you.